You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionFit.com, and Mark the Greasy Meatball Sebastian from OptionFit.com. The Option Block is brought to you by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. And now, get ready to hit the Option Block.
Welcome back to the Option Block, everyone's favorite. I know it's mine. Hopefully it's your favorite bi-weekly source for all things options related. I apologize to those of you looking to us at our usual live time. We're changing things up a little bit. That's probably why I sound a little bit different to you today as well, because we're not coming at you live from our studio in Chicago today. No, we're coming at you live to tape from the Scenic and Sunny Options Industry Conference here in Miami, Florida. A fun one. I can't just do the Option Block by myself. No, that would be no fun. So we rounded up a fun guest, Mr. Greg Stevens, the Vice President over there at Fidelity Investments. Greg, welcome to the Option Block.
Thanks, Mark. Good to be here, and actually great to be in sunny Florida.
Yes.
Leaving that dreary New England weather that we've been having. It seems like the endless winter or spring.
It was garbage in Chicago, so I can only imagine it wasn't much better in
a little
southern
snow
New
in
England.
Chicago, right?
Yeah, it was 75, and the next day it was snowing. So it's one of those you can't really keep heads or tails of what's going on. But we can keep tails on what's going on with the show. And Greg, I'm glad you're joining me because it gives me a chance to use a transition we don't get to use a lot on this show, which is the interview block.
The interview block.
All right, welcome to the interview block. If you're saying to yourself, what the heck is that? 800 episodes of this show. I haven't heard that in a while. You're right. By the way, Greg, we just had our 800th episode of this show.
Yeah, congratulations.
I've seen
that, right?
That is when you hear that number, it's kind of mind-numbing. Like, really, 800? But yeah, that's a lot to process. But we don't get a chance. Within those 800 episodes, we have not had a chance to do a lot of interview blocks. So I'm excited, Greg, you give me a chance, my audio guys get a chance to bust out an old transition. So let's start with that. We're obviously down here at the Options Industry Conference. It's a big event, a lot going on, a lot of different players here from all different aspects of the space, exchanges, brokers, trading firms, etc., vendors. Well, let's start there. What is it that brings you guys at Fidelity? What brings you down here to OIC this year?
Well, I think it's just exactly what you said. I mean, it's it's everybody who's here, that we don't normally get to run into, that gather for this event once a year, whether it's vendors or the exchanges, other brokers, colleagues, and others that we just get a chance to, meet up, see what they have to say, see what's new and interesting, coming in the way of new products, regulations, what others are seeing in the industry, and really just take a look back on, what's happened over the past year. So it's definitely gives us a chance to see what's trending out there.
Big breaking announcements this year from Fidelity and the options side.
Yeah, no big aha moments. I heard that mentioned earlier in a panel this morning. Those moments when we decide that we're going to do something, but nothing in the way of Fidelity. And really, quite honestly, there's not been too many aha moments in any of the panels. I think at this point.
A lot of things have been going on. We've obviously been having our own fun little mini conference here in this studio over the past couple of days. So it's always fun to get the one-on-one perspective here at OIC. There's a lot of things that are coming across our docket here that people want to talk about here, as you might imagine. One of the big ones, it is a very exchange-heavy conference, so the notion that we are MIAX just launched their third exchange. That brings us to a grand total now, Greg, of 16, which is almost as ridiculous as 800 episodes of the option block, each one equally ridiculous in their own way. But it's interesting because this poses a lot of interesting opportunities and also challenges for a lot of the audience. You guys interact with a lot, of course, of the active retail audience. What are you guys' thoughts on this continued proliferation of trading venues out there? I mean, 16, it's a lot to connect to, it's a lot to trade across, but it also could pose opportunity. How do you guys see it, and even more importantly, maybe how do your clients see it as they continue to see so many different venues out there?
Well, it's definitely different for the retail investor than an institutional or the market makers or the exchanges. And interestingly enough, I heard Andy Nybo mention this morning that you may not like it, but there's probably more exchanges to come.
Probably heading to 20 before we head to 10, I would think. Yeah.
I think that's exactly right. I mean, for the retail investor, I mean, I don't know that it really matters to them, that there's one exchange or 16 exchanges. What it does matter to them is the liquidity, the breadth of the market that's available for trading purposes, and we know that fragmentation has led to wider spreads, has led to just different different challenges for the retail investor, where to go, what to do, and so I think that's the biggest challenge for us is trying to give give the retail investor a good sense as to where they can execute those orders and actually get some quality executions, but. For us, I mean, other than the cost associated with market data feeds and other things, there's not a huge change.
That's another one that unfortunately doesn't seem like it's going away anytime soon.
No, not at all.
Data, they got a firm grip on that, and they're not letting go anytime soon. Well, you mentioned kind of market quality and executions. That's a big, obviously important one for you guys. And one of the other contentious aspects of that down here is the notion of auctions. A notion of how much of the business these days is transacted in these. Effectively, they term them price improvement auctions. Some people will debate. It's a very contentious issue. Some people will say it's fake, false price improvement because the spreads were too wide to begin with. Others will say it's great because it gives people tight executions. Retail loves it, et cetera, and so on and so forth. So it's a very divisive topic. I'm curious, Greg, where do you guys come down on the notion of auctions? Are they great? Your clients love them, or are they maybe more problematic because they tend to fragment and maybe disguise liquidity?
I think that they do fragment and maybe disguise the liquidity a bit, but more so, we're really focused on the execution quality, and we meet regularly on this and discuss where we're getting good executions. If we're not, we look at that order flow and make sure that it's going to the right spot. So whether it's an auction or it's being handled in some different way, I mean, we pay close attention to the execution quality and make sure that our customers are getting a fair deal.
So it sounds like you're not too upset about the state of the auctions right now. Because the interesting thing is, it seems like when clients, they start off and they like them, right? Because they can hit a bid, they can get a 5 lot or a 10 lot. Usually they're pretty good. When they start getting a little bit more sophisticated, a little bit more sizable, that's when they start maybe encountering some of the issues. Say, wait a minute, here's the bid, but I can only get 6, and I really want 20 or 30. Is that something you encounter where they start to get a little bit more sophisticated, and that's when they maybe start asking more questions about why these auctions are here and how they work and that sort of thing?
Well, it definitely happens, but we also have a desk, that can help handle that.
I have heard of such a thing. Yes. Some crazy people on that desk.
It's the block desk, right? So, So we have different ways of handling, when, large orders come in versus, a 1 or 2 or 10 lot, that's available. But it definitely does, cause problems. I mean, and the exchanges, as well would like to do away with all or none orders. But, I mean, there is a reason why, our customers like that. They don't want to have a partial execution. They don't want to get, one contract traded when they want 10. And so I think the fragmentation does come into play. And with the executions and just the larger the orders, to get the more creative we have to be in how to make sure that our customers can get those things executed. And we have desk, we have other services that we can lean on to help.
And the other thing that seems to be pretty popular in the retail side of the fence here at this conference, and whenever we ask our audience when we come down here, they always bring this question up. Make sure you ask about this. And particularly this time of year, earnings season, which is, of course, your typical retail guy out there. He can go out, he could buy his shares of his Amazon, his Apple, his Google. He could buy them in the day. He could sell them and close them out after hours if he wants. He can't do the same thing with his options. And it's deeply frustrating to a certain segment of the audience out there, particularly around this time of year, earnings season. I'm sure you get this from your clients and customers as well. Are you guys in favor of maybe expanding that? I have a feeling I know how you're going to come down on that, but let's get it out there in the open. And then B, do you think we're making any progress toward that?
I'll take the second question first. No, I don't think we're making much in the way of progress of expanding the trading hours, and we'd definitely be in favor of expanding the time frame. We do now with SPX and VIX options. They do trade prior to the 9:30 open and after the 4 o'clock close. But those are special cases, and we don't have the Googles, the Apples, where during earnings season it'd be fantastic to be able to go out, hedge your risk, or get out of your positions before there's a significant move one way or the other. But I don't see much movement in the way of that. Definitely some discussion, and maybe an exchange out there under the cover of darkness is considering it. And they're like dominoes. If one does it, they'll all follow suit at some point. But haven't heard much in the way of that.
Yeah, it seems like there's definitely a bifurcation on that issue where the retail-focused firms, all for it, they want it tomorrow. The exchanges and a lot of the institutional-oriented firms, not so much. They have to staff up. They have to provide the manpower. They hem and haw about liquidity, and it won't be a great customer experience. So I've heard that quite a few times. Interestingly enough, I was talking to the folks at OCC yesterday, and their CEO seemed to he thought it would be a pretty easy lift once they got the technology in place, which kind of surprised me, because a lot of them have always leaned on the excuse of, it's OCC, they won't be able to do it, so we can't possibly consider it. And it seems like that excuse maybe is going away, so that might be interesting. We'll see. Maybe I hate to throw the dreaded P word around of another pilot, but maybe something around, because I'm sick of the penny pilot. It's been over a decade and it's still a pilot, but that's a conversation for another day. But maybe something that let's call it a trial period, where something around earnings season on some of the big names, maybe you roll them so people can get their Amazon out, 'cause that's when they really want it, right? They want it when it's moving in the after hours, and that's usually around earnings time. And that's just anecdotally from looking at our response, that's when people ask us about it. So that would maybe seem to make the most sense. Maybe you don't need to do it on Christmas Eve, well, maybe last year would have been good, but outside of that, when everything was at its nadir and everyone should have bought everything. Interesting things. Those are some of the other big topics. Any other big topics that are really resonating for you? You just came out of maybe the Exchange Leaders Panel and some other sessions. I've been busy in here talking, Greg, so I haven't gotten the lay of the land out there at all. Anything else really resonating to you at the conference this year?
It's been it was a good panel discussion this morning, from Henry Schwartz to Andy Nybo.
Terrible guy.
Right? All those guys, coming in to talk about, the state of the markets, the exchanges, where we're at in the options industry, and all things point, to be pretty healthy, other than, I believe it was Henry who mentioned, the breadth of the top stocks.
That's always I joke with him. That's always his most depressing slide every year. Even though it is up this year, he mentioned that it is up this year. Yeah.
What did he say? There was 133 stocks now that account for 80% of.
Up from like 80 or something last. That's the first time I remember it being up in quite some time. So usually that trends the other way every year. So at least it's not a good number, but it's better than it was, right?
Exactly. And so, we'd definitely like to see that expand, beyond, those 133 names, because I think we have, 4,600 or so stocks that, trade options, and 200 of those, I heard this morning, have no open interest and no trading volume in quite some time. So I thought some of that was interesting, as well as the industry volume, down a little bit from year over year, but I think that we had an extraordinary year last year, and still, he was saying that it's going to be probably be the second best year as an industry that we've had. And so I think a lot of that, leading into the exchange panel, their discussion of, and I was happy to hear, the focus on investor education. So if we're looking to grow this, education works. We see it at Fidelity. I think all the other firms, see that as well. The work that you do here, just the proliferation of good educational information is important, and there seems to be definitely a commitment from the exchanges as well as the beautiful venue we're at, and the OIC, who is running this conference, do a great job of getting the information out there. And the more we can do, the more information that's available, from hedging to income generation, and why options are an important part of an investing portfolio, I think resonated this morning as well. And if we want to continue to grow that volume, we need more participants. We need wider. We need more breadth, of the underlyings being traded. And so I think that it was a good step. It was refreshing to hear the exchanges, commitment, as well as acknowledging the firms, what we've done, in the past. So I thought that was a really good discussion, on their part this morning.
It's interesting they would mention that, because I brought that up with them many times before. Because it used to be, when I got into this business, I'm sure when you did too, every exchange venue had some sort of educational or outreach arm, right? They all saw that as part of their mission. They were effectively not-for-profit public utilities for the most part, right, and they wanted to get the word out there. Now they've all migrated into for-profit entities, and all of a sudden they have shareholders and analysts, and they all say that education is expensive. Why are you wasting money on that? So they've all kind of abdicated that to the OIC, which does a great job. I think but they can't do all the heavy lifting, and they've also abdicated it to firms like yours. They think, okay, right, let the BDs pay for that. So I would like to see. Look, here we are with 16 exchanges. We just had NASDAQ in here. They have 6 of the 16 exchanges. Not an educational, outlet amongst any of them. Right. SIBO is the last of any of them that has any sort of dedicated educational arm. So I would like to see, hopefully they mean what they say when that comes. Because they've said that a number of times, and yet they say, okay, OIC is doing it, which is, again, they do a great job. There's only a couple of guys. They cannot cover the depth of the entire industry, nor can we, as big as our network is, nor can we cover the entire world's needs for all these things. So it is kind of interesting. They say that a lot. I would like to see maybe some more concrete steps towards that. Maybe some more educational arms. Maybe, God forbid, an exchange should have an educator on staff, right? That would be interesting. It used to be that way. All of them had them, and now they're all kind of gone. So hopefully, it's got to be frustrating for you guys too, because they make, okay, you're the BD, you go do all the front-reaching educational work, and we'll be back here, right, processing our transaction fees.
Yeah, it was encouraging. I think one of the panelists, mentioned that they can't abdicate all the education to the retail firms or the OIC, or they have to play their part in it. So, like you say, hopefully they mean what they say, and we'll see a little movement on that, because there's definitely plenty of opportunities for them to share, to share the information, especially with the retail firms. We have the OIC in, we've had the CBOE in, we're hopefully going to get some of the other exchanges to come in and chat with our investors as well. And I think that shared information, whether it's about products that they have at their own exchanges, or just in general, it's good to get those perspectives and one or two little things that they can share that somebody may not have heard before. It's fantastic. Anything that we can pick up.
What else is fantastic is, listeners, we can't leave you hanging, so we're going to do a real quick, we're at the conference, so we're limited in how much data we can pull, but we'll do a real quick edition of the Trading Block for you.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, welcome to the Trading Block. This is indeed the portion of the program where we break down what is trading. Like I mentioned, we're kind of in a studio here in nice and sunny Florida, so we're not glued to our screens. But coming into partway through our show here, we're seeing the markets kind of mixed. The NASDAQ leading the charge slightly to the upside of about nearly 0.2%. S&P almost literally unched on the day, so not much going on there. And the Dow off a little bit, off about 0.1% to the downside. So kind of a little bit of a mirrored, it's kind of been a weird market we've seen of late, Greg, where what kind of day you're having almost depends on what you're trading, right? In terms of, are you a large cap guy? Well, okay, then you're rallying today. Oh, you're kind of maybe, shall we say, an old world economy of the Dow. then maybe you're a bit of a laggard today. Oh, you're a tech-heavy NASDAQ, you're a rally. It seems like there's this, it may be trifurcated with those three indices, obviously, out there. Every index is kind of living its own life these days, which is kind of interesting. Are you seeing that a lot as well? People are kind of coming to you saying, hey, what's up with this market these days? It seems like they're all kind of scattershot, or are they kind of just hunkering down? Anecdotally, what are you guys seeing from your Fidelity clients right now? Are they excited about these continued ever-present highs in the market? Are they worried? What are you guys hearing?
Well, I think that maybe a better word than scattered is transitory.
From
That's
why I bring you in for these great.
From Mr. Powell, his comments yesterday. I think that transitory statement sent the markets reeling a little bit, and very interesting. But Fidelity, our investors and our traders and our clients are definitely concerned about the market highs and. Where do we go from here? Are we going to take a leg down? Are we going to continue to grind higher? At this point, so a lot of good questions, coming out of that, and a lot of the discussions we'll have is, do you need to hedge? Do you want to generate some income? But we definitely get those questions, and the guys Trey and Brian and Colin and Constantine.
Never heard of any of them.
Yeah, right. They're wholesale names now, but they get a lot of those questions and talk with customers about what their investing strategy is, what they're looking to do, how they might manage the risk that comes with higher highs and the market in general, and what seems to be a very news driven, as we always are, but it just seems a little more. Waiting on trade, waiting on the Fed, waiting on what the next comment is going to be. But a lot of good discussions at Fidelity around that.
Looking here, I mentioned transitory. That's a good word. I like that. But looking here at the cycle, of course, we did see Mr. Powell spooking markets a little bit earlier this week. We saw the VIX threatening 15. Today it's about 14.5 VIX cash out there right now. So still far higher than when it was the last time we all gathered here together. Luckily, I don't think I'll be doing my live prediction for vol views this week. So hopefully, I don't think I was that high. So we shall see. A couple of days yet for it to settle down here. Of course, it's a big earnings week still. We saw Apple earlier in the week. Number wasn't fantastic. iPhone still not great, but the market's still liking what they saw out there. So apparently that's all that matters at the end of the day. We also saw McDonald's, Pfizer, Qualcomm yesterday. Today we have Activision, Blizzard, and everyone's favorite contentious name, Herbalife. And then tomorrow, some name I never heard of called CBOE, something like that. I'm not familiar with them, but I hear they're reporting tomorrow too. Another interesting thing I'd like to get your thoughts on, Greg, because we had Henry in here yesterday, and he was mentioning some of his little data points are kind of interesting. He was mentioning the overall volume is down, but we're seeing and that's mostly concentrated in the indices and in the ETFs. When you get into the single names, that volume is actually up year over year, which I thought was kind of a surprising development. And looking here at some of the numbers we're seeing, I could maybe see why. He was mentioning, there's a lot of activity still in the IPOs like Lyft and some other names. I'm looking at Lyft right now. Lyft, kind of came out of the gate like a lot of these IPOs do, roaring, and then everyone thought maybe it would trail off, but it actually is still doing fairly well. I'm looking at the top positions right now, and it's actually over 300,000, almost 310,000 contracts open in Lyft right now as we're speaking, and the ADV is pretty robust. So it's looking here, the number one position Lyft coming into this was nearly $60, about 59, and it was at the June par calls, June 100 calls, which have about 11,000 and change open there, nearly 1,600 opening yesterday. So a lot of action there in Lyft, and then we have the October 62 halves. I think you talked about those before as well, with about nearly 11,200 as well. Are you still seeing a lot of interest in the IPO names over there, in the weeks after? I'm looking at Pinterest now. It's doing all right, not as well as Lyft. But do you think Henry's right that it's kind of maybe this new wave of IPOs that is driving single name interest? Or maybe is it something maybe broader? Or maybe is it that, that wave we've all been riding for years now of active versus passive? Maybe that's starting to crest a little bit. Maybe people are starting going out and actively picking single names again. What do you think is driving the volume in the single name options versus the equities and the ETFs?
I definitely think that some of the recent IPOs, the buzz around those names probably has created some additional interest in the single names, but I also think, I mean, you mentioned December 24th. We should have all been out buying, buying everything we could.
We should have been buying everything we could have under the sun, right?
And I don't know that it's so surprising that some of these single names are really driving the business, because there was a significant bounce from the beginning of the year, and that drive upwards probably has created a little more interest in those single names to get. I mean, some of these stocks are up 40-50% from their lows. Thinking of Apple as well. I mean, Apple's had a tremendous run, this year, up to above 210 now, 200, yes. For sure. But it does seem that maybe there is a little bit of stock picking going on out there versus just trading the indexes. But I think a combination of those things, where just some good discussion around the IPOs coming out, as well as that bounce that we've seen so far.
It does seem like it wasn't too long ago that we were debating on our audience was actually kind of split on it as well, when Apple was threatening 150, and everyone was like, "Oh, should we sell the 150 puts?" And people were usually, our audience is decidedly bullish Apple. And when we put it out there to them, they were almost split 50-50 on whether they should or whether they should roll it. So there were a lot of people thought if they broke 150, then that was going to be the beginning of the downslide for Apple, and they weren't going to touch it. So now, obviously, in hindsight, 60-odd handles away, that seems silly. But at the time, there was a lot of hand-wringing. Right. It wasn't that long ago. So it is kind of interesting to see how the worm has turned in just a few months. I'm looking at some of these other big IPOs that have opened recently. Pinterest, of course, that was in the low 30s. That one not doing as much as Lyft, but it hasn't been open as long either. It's only about 50,000 contracts open. Interest, like at the top position in Pinterest, is about 4,000 of the May 30 calls. So interesting, in the money calls, which is interesting. Looks like maybe a little bit of an overriding going on there. And then Zoom, the other one that's kind of surprised everybody, Zoom Video. who thought that one would be the darling of the IPO scene? That one not exactly lighting up the options tape. Only about 10,000 contracts total outstanding there. The top is they're at about 72, almost 73, and the 75 calls in May have about a little bit shy of 1,000 contracts. So it's not a lot going on in that neck of the woods. But there's a lot of stuff for us here still going on. So you feel like answering some questions, Greg? You got a few question answers going on in you? You ready for it?
Yeah, let's do it.
All right, let's do it. So without further ado, let's keep on rolling right on into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is indeed the portion of the program where you guys take the reins, your questions, your comments. We try to provide a little bit of insight here whenever we can. Let's kick things off, Greg. We have a question. We usually ask our audience a question of the week every week. And this week, it's earnings season. So we thought we'd ask them, some big names popping off this week. You have Google, a.k.a. Alphabet. You have Apple. You have GE, McDonald's. Those are just a few of the names we gave you. We thought, which of those four names are you guys most excited to trade some options on this week? I'm looking at the answers right now, Greg, so I cannot participate. So I will leave it up to you. If you have a favorite of those four, by all means, GE, Apple, Google, Alphabet, and McDonald's, let us know. But more importantly, which do you think our audience is the most excited to trade this week?
I think it had to be Apple.
How could you possibly pick that, sir? Actually, it was a tighter contest than I thought. Apple did not run away with it. But so far, there's still a little bit left. Obviously, the trading week is not done. But there's 38% for Apple and 33% for GE. So GE getting a little bit more love out there than perhaps you might think. And then McDonald's and Alphabet. Have you noticed, we've seen this anecdotally, have you guys probably seen this as well over there at Fidelity? It seems like ever since the transition to Alphabet, Google has lost some of its trading luster. The vol is down. It seems like the volume is down. It just seems like it's now nowhere near as compelling of a trading vehicle. Have you seen that as well on the Fidelity platform? Are Fidelity clients not slinging Alphabet the way they used to sling the old Google?
I'll say that I don't know that I have any real evidence, of our customers leaning one way or another, but I do tend to agree with you that it seems to have lost a little bit of its trading cachet, if you will, and not quite as I don't think it's talked about quite as much anymore.
Speaking of which, Google, the Alphabet, they posted their worst day in more than 6 years. That hurt them. That hurt the NASDAQ earlier this week. We had some of our listeners chiming in on that, including Mark Brandt. He wanted to know if that's the canary in the coal mine for the broad market. Well, I don't know about that, Mark, because it looks like yesterday was off. But outside of that, it seems like we still are looking. But that probably gets back to what we were saying earlier about Alphabet, that it's kind of in this weird weird state right now. People don't want to seem like they want to trade it a lot, and but maybe it is that proverbial canary in the coal mine out there. I'm just trying to find some fun questions. How about some put questions? I know you like puts, Craig. How about we'll answer? There's a couple of related questions here about puts. We got Mart03. He wants to know, what is the cheapest way to buy a put? So that's a simple question, but deceptively simple, because we could probably answer that for like an hour. And then the second related question, it comes from, Flyer. And Flyer wants to know, what are some of the best ways to trade put options? So everyone's got puts on the brain today, Greg. I don't know why that is, but maybe that says something about maybe that's the canary in the coal mine right there. Everyone's asking about puts. So we can combine these two into one if you want. We have the cheapest way to buy a put, and then also the best ways to trade. So you could be selling puts there too. That could be your preference. You're our guest. I'll give you pride of place, sir. How do you want to tackle these put related questions?
Let's go with the cheapest way to buy puts. Honestly, stocks don't tend to go to zero too often, and so I think maybe a put spread, is an ideal way to do that. Knowing where you want to start taking advantage of the downturn, you can sell the put where you think there's maybe a little bit of support, for the underlying stock. And if you want to buy it at 50 and buy the 50 puts and then sell the 40s, then you've got a $10 profit. You can take a $10 potential, less what you pay for the put, but you're offsetting some of that put costs and vol that you're going to be paying for that. I think it's an interesting way to do it. We don't always think about that because we want to stocks tend to move pretty fast to the downside, but I think that's a definite way to limit some of that or to reduce some of the costs.
Yeah, put spreads are obviously, we advocate for those all the time as opposed to just going out and buying a put, right? Because it's expensive. It doesn't really work that well over time. It can be a huge drag on your portfolio. In fact, I've often joked that a large portion of the options industry, their day-to-day is devoted to paying for puts, trying to find a way to pay for protection, right? Whether you're an advisor, an asset manager, whatever you're doing, chances are you have a long position, you're trying to hedge it, and you're trying not to pay for it. And that's a good chunk of what your day is. So there's a lot of the industry trying to do what you're asking about right here, Mart03. And you're right, the put spread is kind of the most straight-up way to do that. It's straightforward. It's all in the same month. It gets things pretty easy. Then you can start adding other layers to that. The way a lot of people like to do it too is maybe the old collar. So instead you have the put, and instead of selling the other put against it, you sell the out of the money covered call now. So now you have the long equity position. I'm assuming you're talking about against long equity. That's usually why people want to buy puts, but he could be outright. We're going to talk about it in the context of against equity. So you have equity, you buy the long put to hedge. Then, of course, you sell out of the money covered call. Usually the call is not going to cover all of the cost of your put because in most equities, the skew, the put premium is to the put wing, obviously. So the put's going to be more expensive. So what people end up liking to do is maybe they move that put out somewhere. Studies vary. Somewhere in 3 to 6 months seems to be like an optimal time frame where it's not too expensive. You're not going out 2 years, but it's not going to be decaying to zero in a couple of days either. So you're kind of deferring that decay. And then you can instead look at writing your call in the near term portion. So sell the covered call in the weeklies if you're aggressive, in the monthlies if you don't want to do it as often. And hopefully the consecutive calls against that will do that. And you can obviously do the same thing. You can add that put spread in there as well. So now you have a short put and you have a covered call against that long put. And maybe the combo of those two will, over time, offset that. And you can do that a bunch of different ways. You can do the short put in the same month as a covered call. So now effectively you're selling a shorter duration strangle against your longer put and stock position. So hopefully if you're going to do this, you have some wherewithal into what that means. If things start whipping around the earnings season, you have a lot of short gamma that could come back to bite you. But in general, there's a lot of ways, and you also get in trouble, obviously, too, Greg. Because people start falling in love with things like ratios, right? They say, well, I'm going to buy one put and I'm going to sell two. That wipes out most of my premium. What if I do? If I buy one and sell six, I'm going to collect a credit for my protection here. And so that's a way I would caution you maybe not to proceed down, because that way down that road lies madness once you get to crazy. Have you seen that as well? Where people get a little bit too excited about their ratios, Greg?
Yeah, I think sometimes we as investors, start to look at. You look at things a little differently, and not with our risk management hat on, and start to think, well, I did this on a 1x1. What if I do a 1x2 and then a 1x3, and then next thing you know, a tweet, some news event comes out, and next thing, then everything that you worked for is gone. So we definitely caution people, as you stated, to make sure that they fully understand what they're getting involved with and the risk that's associated with it. So I think that we do. Investors do a pretty good job of managing that, but at times we kind of forget ourselves.
Yeah, I think so. And the other question is related with best ways. I think we would put some of those as some of the best ways to trade put options as well. Obviously, you could sell them too. We're not holding that against you. If you're going to do that, probably maybe do a spread as well to mitigate against the blowout risk. But if you're selling a put at a level where you've identified that you're comfortable buying the stock, then the other put leg, you don't need it. If you're comfortable working a buy order in a stock, right, you should be comfortable selling a put. It's the same thing, and you're getting rewarded for it. So that at least should be something you're comfortable with, as long as you've done your due diligence ahead of time. And yeah, the best ways to buy them, I think we just kind of laid that out for you. With I like to put spreads, very straightforward. If you want to add that covered call kicker, it's another way to pay for it, get a little bit cheaper, and now you have a protection that's fairly low cost. Let's see, we got some other put-related questions. Definitely a put day here, Greg. We got Scott Somer chiming in about Tesla. I'm sure it's just a little name you may not have heard of, Greg, called Tesla. Gets a lot of interest from our audience, as you might imagine. He's talking about, we talked before, most of the open interest in Tesla options is dominated by extreme out-of-the-money puts. Like in Tesla's around 2-something, 240, to somewhere. I have to pull up where it is today because it's moving quite a bit. I think it rallied, actually. There's some news. Maybe they have some funding finally, but funding secured. But let's see. I have them right here. But yeah, in general, the open interest out there is dominated. They're at 239 today, so pushing 240, up 5 handles. So dominated. The top 5, even most of the top 10 are Jan 50. 25, 10 puts, extreme out-of-the-money puts. And it's been that way for some time. We just first discovered that a year or so ago, even more on the network. We started doing some scans. I said, wait a minute, I thought it was wrong. I had to run the scan again. I said, wait a minute, all of the open interest is in the 50 puts in time. It's such an active name. You think it would be, at the money, near at the money call, something like that. Nope. And that's still the case today. And so he's writing in, because these puts have a lot of life to them. People trade them quite a bit. He wrote in to let us know that the 266-day Tesla 65-50 put ratio, so going back to ratio, is now an 85-cent credit. So he wants to buy the 65, sell the 50s, do it, I'm assuming 1 by 2, and collect 85 cents there, Greg. So what could happen? If he gets to 65, how can it go to 50, right? It can't possibly happen. But thank you for that Tesla put update there, our audience.
That's interesting.
The savviest of the bunch. Other people saying these puts won't come into fruition because if Tesla gets down there, Google will come buy them. Interesting. Maybe others have suggested Apple, but there's quite a bit of those in there as well. Let's just see really quick. We got some lengthy ones. I don't know if you want to do a treatise on on rolling flies right now here, Greg. Let's see. Here's an easy one. We'll wrap it up with this one. Nice quick one here, Greg. This comes from. Actually, I'll give you a choice. Do you want to do covered puts, or do you want to do which of the Greeks do you use the most and why? I'll give you a choice.
Yeah, let's go with the covered puts.
Okay. We're on a put theme today.
We don't do
Lincan,
those too often.
or Lincan, he wants to know, my go-to option strat is to sell covered puts on stocks that I want to buy and then get paid to wait. If the stock comes my way, I eventually trade out of it using a covered call. What do you think? Is it savvy or stupid? That's pretty much the wheel trade right there. We like that trade. You sell the put, get the stock if you need it. If you don't, you collect the premium. If you do get the stock, you wheel out of it with a covered call. I like that trade. I think that's not bad. Greg, are you a fan of the wheel trade as Lincoln has unknowingly described to us?
I'm very much a fan of that. I use it myself. It's a good way to either get into the stock or to collect some premium along the way. And with weeklies and monthlies, I mean, there's always an opportunity to manage that position and make it effective for you. So I love the trade. I think on a covered basis, I mean, it definitely adds to your portfolio.
So, yes, I think we both would deem it savvy there, Lincoln. So, congratulations. Ballyhoo to you, sir. As we keep on going into our final segment, it is time to go around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. This is indeed the portion of the show. We tell you what's on our radar for the rest of the trading week. We kind of mentioned the earnings at the top of the show there. The big names popping off today, Herbalife and Activision. Tomorrow is SIBO, of course. It'll be interesting to see how the volatility space has been treating them over the last quarter. I know the futures are still a bit of a question mark. The options have been kind of light as well, so I'm going to go out on a limb and say maybe it hasn't been lighting up the tape, but we shall find out tomorrow over there on the SIBO numbers. The rest of the week we have some unemployment and other numbers coming out here, which are, of course, maybe merit watching, those pesky numbers out there these days. But, Greg, what is on your radar for the rest of this week, sir?
I think it's earnings. I mean, how we're going to react. They seem to have been a little bit better than maybe was expected out of the first quarter. So I think earnings is going to be another big driver. I think it'll be interesting to see the China trade deal, which is supposed to. There was a rumor out yesterday, I think, that could potentially be announced by next Friday.
Must be a day that ends in Y because there's a China trade rumor afloat.
Right? So it'll be interesting to see if we can bring that to fruition and get it completed, and then what? What are we going to talk about? If it's not trade, if it's not earnings, where do we go from there? But I think those two things, have been dominating the market, as well as, Fed, the Fed announcement, which is behind us at this point. But earnings and trade, I think, are the two big drivers for the foreseeable future. Yeah,
it will be nice if you do get some sort of trade deal, because then, just to take the focus off macro for a little bit, wouldn't they worry? But the West Right earnings season is nice. You can, if you so choose, you can ignore the macro currents and just focus on one very micro event, which I think is refreshing for a lot of the audience. Of course, we do have non-farms this week, but with the Fed, you're right. The Fed's kind of behind us. That kind of takes some of the wind out of non-farm sales a little bit, unless that number is extremely aberrant one way or the other. I don't think non-farms is really going to be the market mover that it once was, at least not this week. Well, Greg, I'm glad you could join me here on this kind of fun, on-the-fly episode of the Option Block here from the not-so-sunny today, but they tell me it's sunny here in Miami, not so much today here. But before we go, Greg, we kind of hinted at the top of the show, but if you have you want to leave our audience with any kind of hints, any teases of what's coming down from you guys and the Fidelity Options team, and maybe if they want to learn more about what you guys have cooking in the land of Fidelity Options, where should they go? What should they do, sir?
Yeah, no, I think that for the audience, tune in to the Fidelity platform. We've got a lot of good educational segments, with Trey and Colin and Brian and the guys, that we do on an ongoing basis. We're still moving that along, and they do a lot with our platforms and just some really good information out there, when it comes to the Fidelity platform. So definitely looking forward to continuing that. We've got a big event coming up next week in Texas, where we're going to talk basics and income generation with the OIC.
Oh, great! Can they register through you guys or through OIC? How do they get?
Register through the Fidelity website. Okay. So that'll be fun. We're going to have a good audience for that. Should be very informational, especially if you're looking to learn a little bit more about what they are.
Where in Texas is it going to be?
Westlake, just outside of Dallas.
Okay, so there you go. So if you're in the Dallas Metroplex, as they like to call it down there, then check out maybe Greg and see some of the OIC folks and everyone out there in scenic and sunny Texas over there. And they made it easy for you to find out more, listeners. Fidelity.com/options is the place to go to kick the tires and light the fires. If you want access to all this great educational stuff, the active trader desk with Trey and Colin and all those guys, and indeed some of these cool events, then Fidelity.com/options is the place to go. And on behalf of Greg and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for sending in questions. We'll get to more. Don't worry. We had a shorter show today, but we'll get to more. We'll be back to our regular live schedule as well. Hopefully next week. There's a lot of conferences going on this time of year, listeners, so it's messing with our schedule a little bit. But we're keeping you busy on the content front. Don't worry. And we'll see you next time for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.